All right, hi guys. This is a short video over accounting errors and bank reconciliation that will hopefully help you as you're working through the material in the chapter you're on this week. So the first thing I want to start with are some different types of accounting errors, and then we will work this into bank reconciliations. So these are a list of different types of errors, and you just need to know a definition. This is very theory-based here, knowing what each of these words mean. So an omission is the first one. That one is an easy one. It means an accounting transaction that was never recorded. So if you forgot to do something, it would be considered an omission. The next one here, accrual or deferral, this refers back to when you did adjusting entries. So if you did not do your adjusting entry, if you did not accrue or defer something, then you would have this type of error, an accrual or deferral error. So think of that as your adjusting entries errors. Or it could be for the wrong amount. So you didn't do it, or it was the wrong amount. A classification error means that you've posted something to the wrong category or the wrong account. So it should have been to rent expense, but it went to insurance expense. So a lot of times there'll be a drop-down menu and you'll just pick the wrong account by accident. That would be a classification error. Arithmetic error, that one's easy. Obviously you did the math wrong, so added up something wrong. Incorrect accounting principle. So this would be when revenue was recognized before it was earned, is an example. So I don't know that we've talked about unearned revenue yet, but another example would be expenses. So if you buy like a piece of equipment and you expense it all instead of doing depreciation and capitalizing it, then that would be an incorrect accounting principle. So that would fit here also. An improper estimate is that you have a wrong percentage or a wrong useful life. So examples, depreciation, if you use the wrong useful life, you're going to calculate that estimate wrong. A transposition error is when you have flipped numbers or reversed them. So the number should be 739, but you put it in as 379. So you may just have looked at it wrong. It might be a typo. You put it in backwards. That's considered a transposition error. A slide error is when the decimal place is off. So instead of 1,000, you put 100, or 100, you put 1,000. So you've either added a zero or subtracted a zero. So you have the wrong number written down. And the last one is a posting error, that you have credited something when it should have been debited or debited something when it was credited. So you've gotten it going the wrong way. So that's an error. That's something I see fairly common right at first in accounting, is that you'll do a journal entry and you'll have things backwards. So that would be a posting error. All of these different types of errors, there's some very specific ways to help you find these errors as you're working on a problem or working within a business. So one of the first one is a monthly bank reconciliation. If you have forgotten to post something or you wrote it down for the wrong amount, you may find it when you do your monthly bank reconciliation. Another way to find errors is from your trial balance. When you prepare that trial balance, maybe you've debited something instead of crediting it, you may be able to find it there. Some account doesn't balance then because you've got too many debits and not enough credits or something like that. When you're reviewing your adjustments, you might find errors there. So if you compare your adjustments you did last month to this month, you may be able to find an error there. You can have internal audits. So that would be when somebody within your company reviews your work just to make sure that there's no errors, that everything is being done right. That would be an internal audit. And then an external audit is when you pay somebody from outside the company to come in and look for errors, look for fraud, those type of things. So those are the most common ways to find errors in your accounting records. So the one that we're going to focus on is the bank reconciliation, since that's what you're talking about now. And the reason we're talking about that one is because cash is the lifeblood of your business. That is the most important asset that you have. Even if a company is profitable, they're making money, but if they don't manage their cash, then they could still have problems. And so that is why we need to watch it. It's also something that could be hidden or moved very easily, and so it's a top thing for theft. People are much more likely to steal cash from your company than they are to steal inventory or supplies or something like that. So we want to make sure that we have internal controls in place to protect our cash. And one of those ways is this bank reconciliation. So bank reconciliation should be done once a month. at least once a month. And the purpose of it is to make sure that what the bank says on the bank statement and what your cash T account says, we can figure out why they're different. We want to make them the same and make sure that there's nothing we have missed or that the bank's not taking money that they shouldn't or something like that. So one other important thing is the person that does that bank reconciliation really should not be an employee who has custody of, so they're not one that have cash, have the checks, have the credit card, or they're the person that keeps the records of the cash, or the ones that enter all the transactions. In reality, it should be somebody different. In a small business, that's really hard to do because there may be one person doing all of it. In that case, you should have the owner of the company or something should be monitoring it and making sure that it is being done correctly and there's not any problems there. But in a large company, the goal is to separate all of these job duties. So when we look at our cash T account and our bank, there's going to be things that are different. So if you look at our books, there's some things that could be missing or things that are on the books but not on our bank statement. So these are things the bank does not know about. An outstanding check is one of those. So an outstanding check is a company check that has not cleared the bank. So if you write checks the last day of the month, they have not cleared the bank yet. The bank doesn't know about them. They'd be considered outstanding checks. Deposits in transit are company bank deposits not credited to your account yet. So you put it in the night deposit at the bank and they just have not recorded it till the next day, something like that. And then the last one is book errors here. So that is when you make an error on your books, you write something down wrong, you forget something like that. On the other side are items on the bank statement that are not on the books. So things that the books do not know about. So examples of this would be a bank service charge. So if the bank is charging you a fee, you may not have that on your books. If the bank is collecting a note, so you've loaned money to a customer, they have repaid it, probably with interest, they pay it directly to the bank instead of paying it to you, that would be a collection of a note. And a non-sufficient fund is a bounced check. So they wrote you a check to buy something and it has bounced. They didn't have enough money in their account. And the last one is the bank errors here. So this is the hard one to me because we saw it on both sides. One was a book error, one is a bank error. So when you see this, it's not as obvious which side it goes on. You have to figure out who made the error to figure out if it should be on this side or this side of our bank rec. So when we set up our bank rec, we're going to start off with what the balance per our books was on the last day of the month. So this would be the balance in our T account. And then we're also going to look at our bank statement and see what it said on that same date. And our goal is that these two numbers should match. When we get down here to the bottom, we're going to have all these differences we're going to list in here, and then we're going to make them match at the end is our goal. So on our book side, we're going to list things that are items on the bank statement but are not recorded by the company. So we have not put them on our books yet. The books did not know about them. On this side, we're going to put things that are on our books, but not on the bank statement. So there's things that the bank did not know about we're going to put on this side. And our goal, as I said, is to make sure these two balances equal in the end. So when we look at our book side, there are going to be things that we add and things that we deduct. So the things we're going to add that they listed before, so we collected a note as an example. So that was somebody was paying us money. The bank took in that money, but we didn't know about it. So it's going to go on our book side and it's going to increase our books. So the note and the interest. We do list these separate so that when we get to the journal entries, we know the difference between the two. So that's why they would be one transaction probably, but we list them separately. And then the things that we're going to deduct, things like NSF checks, bank service charges, these are things that the bank took out of our account that we do not have on our books yet. So that's going to go over here. On this side, we're going to have things that we add and subtract also. So example of something we add is a deposit in transit, and something we would deduct would be outstanding checks. So these are things that were on our books, but the bank did not know about them. So whoever doesn't know about them, that's which side it goes on. So let's look at an example here. So at the beginning, they give us a cash balance and a bank balance. These are going to be the numbers that go at the top of our bank statement. And then they give us a list of transactions. So the first one here is some checks outstanding. The next one is a night deposit. Then we have an error here. The bank charged for a check written by another company. Here we have a note that we collected, and here we have an NSF check. So the first thing we got to do is decide which side does it go on. Who does not know about it? So outstanding checks, the bank does not know about those. So it's going to go on the bank side. A deposit in transit is also going to go on the bank side because the bank does not know about that deposit yet because we put it in the night deposit after closing that night. This one is an error, so we have to figure out who made the error because an error can go on both sides, as I said. So this is the bank made the error. So this is going to go on the bank side. This is a note. So a note is something that the bank collected, but the books did not know about it. So we'll go on the book side. And then the NSF check, that is something the bank took out of our account and charged us a fee. That is going to go on the book side because the books did not know about that. So that's the first step, is figuring out where everything goes. So when we get to our bank statement or our bank rec, first we got our balances up here, and our goal is to both of these numbers will match down here. So on this side, we're going to add that note that they collected plus the interest. So as I said, we're going to list these separately. So those ones we're going to add because they make our book account go up, and then we're going to deduct things that make it go down. So the NSF check that was returned and the bank service charge, we're going to subtract those. So when we do all of this math, we come up with 36,020. That is our bank balance, or that is our correct balance in our books. On this side, we're going to have some things that we add also. So deposits in transit make our bank balance go up, so we're going to add that. And then we're going to subtract the outstanding checks because the bank did not know about those. So if we do this math here, our goal is that the number matches this right here, which in this case, it does. So we did it all right. One thing I will warn you, I have seen people do bank recs where they kind of understand it, but they take all of these numbers and they put them like in the wrong corners totally. So these, instead of adding them to the books, they subtract them from the bank. And these, instead of adding to the bank, they subtract it from the books. So if you put everything in the opposite corner, surprisingly, you will still balance down here possibly. And so you may think you're doing great, but everything is the wrong place. So that does not work. So just make sure that you figure out which of these quadrants it goes in. The one last step here that I'll mention is anything that's over on this side, on the book side, we have to do a journal entry for. The easy part is that cash is part of that always, because what we're trying to do is get our cash balance in our T account to match this number. So cash is part of every journal entry. Cash would be going up here because we're adding it. So you would debit cash for these two transactions. And then these ones, cash would go down. So you're going to credit cash for these two transactions. So all you really have to do is figure out what the other account is here to do these journal entries. So that covers everything in different types of errors and bank reconciliation, just for a quick review. After you've finished this and you've reviewed it, there is a quiz that you can complete that is all multiple choice, and you can take it as many times as you want. So each time you take it, the questions could be different, but it's good review, and it's a good way to make sure that you understand this material. All right, have a great day.